So clients see clearly the BRICS plus currency unit. What does it represent and why should investors care now?
Well, this is a project that BRICS Plus has been working on for the last 2 or 3 years now, and really it is to replace the dollar not as the global reserve currency, but as the trading unit that they use between themselves. There's like $6 trillion a year of global trade, about half of which is between the BRICS countries themselves, but they have to, at the moment, they have to use the dollar as part of their transaction process. Having a unit of account, and this idea is called the unit, is something that would actually cut the dollar out of that process. And that has big implications for the financial system because, of course, $6 trillion a year of global trade is $7.5 trillion a day of FX that is effectively leveraging and trading around that absolute flow. So this is a very, very important potential shift in the way that accounting is done and transactions are done between countries outside of the West.
Is there a particular catalyst that will bring this to the fore?
Well, there's a meeting on October 22nd actually in Russia, where I think there's quite a high possibility that they may use this meeting to announce the arrival of this new unit for next year. And there's been very interesting work done by the BIS, which is the central bank and central bank, about doing this in a tokenized form, doing this as some form of blockchain-enabled transaction process. So there's a lot of things coming together here now, and I think investors need to just bear in mind that could really rattle some cages here, particularly about the use of the dollar and the de-dollarization process, which has been going on in the background for a while now. But I think this could be a real shock to the system if they do announce it later this month.
Mark, how do the fast-growing petrodollar economies of the Gulf states respond to an initiative such as the unit?
Well, I think this goes back to the fact that when the US and the West put the sanctions on Russia, they effectively broke the petrodollar system so that effectively oil exporters were no longer buying US treasuries to recycle their surpluses. Now, one of the discussions about de-dollarization, there's a lot of people who see it as an attack on the dollar's role as the global reserve currency, but that's kind of missing the point here, really. The fact is that if you have a surplus because you've sold so much oil to, say, China, if you have it in this unit, you can use that for trading with other countries, not just with China, but also, I think this is much more important for the long term, you can start to use it for investing in those other BRICS countries. So what we see is not just trade, but investment being driven through this common currency. And the idea really is this is going to be constructed, as we understand, to be 60% basket of currencies and 40% gold. Now, this is something that's almost already working. If you've got too many yuan or RMB, you can exchange them for gold on the Shanghai Gold Exchange. So effectively, this is almost in place already. What we would see with the unit would be to formalize this and mean that the money that flows through trade will also flow back through investment in this same unit, if you like. So it really pushes the case for a bilateral world, if you like, of the West and the rest. The West uses the dollar, but the rest will increasingly use this unit.
Recent stimulus announcements in China are not to be conflated with the massive liquidity injections we saw back in 2009 and 2016. What do you make of recent announcements out of China regarding stimulus activity?
Well, I don't believe it was a bazooka. I don't believe there's a massive monetary stimulus. In the same way, I didn't believe there was going to be a pivot last year from the Fed. This is all, in my view, hyperbole coming from the same people in these sort of high noise level fixed income markets. What I see is happening here is part of an ongoing process of the controlled demolition of the property sector, not the property as in home ownership, but the property developer sector. Xi said back in 2021 that homes are for living in, not for speculation. He said they were going to deny any more liquidity to the property developers. And so down they came with a big bump. The Western investors ignored what he said and have constantly expected the Chinese authorities to come in and bail out the property developers, just like would happen in the West. But that's not the way that China operates. And what I think we've got here is a provision of liquidity and allowing both the local governments and the local people to buy this excess property, excess inventory at lower prices. So what we're seeing here is creative destruction in the kind of Austrian sense. This is not about encouraging consumers to borrow money and run out and buy stuff so that markets can clear at the higher price. This is about enabling the markets to clear at the new lower price.
Last time we chatted, Mark, I think it's fair to say I would summarize your investment view as being relatively bearish treasuries, constructive on gold, and negative on US dollar performance. It seems we are still very much in the same sort of environment. Any thoughts?
Yes, I think so. Essentially, a lot of those good numbers that are being touted around about the US have to be put in the context of massive increase in debt. And you can always make your activity look good if you're running it off borrowed money. But if you are an investor, increasingly, unless you have to buy US treasuries, the question really has to be, why would I? Why wouldn't I borrow? Why wouldn't I lend to some emerging markets who offer me a high yield and ultimately with better balance sheets and less issuance, more stable environment? And yes, the thing I do point out is that the dollar is 70% of global equities are in the US, but that's not 70% of the opportunity set. And if the dollar were to slip below 100 on the DXY and start to gather some downward momentum, there's going to be a big rush by those overseas investors who've been sat there in a barbell, basically, of US cash and US tech. And if they start to deploy some of that US cash anywhere else, then you'll start to get an acceleration effect on the dollar itself. And then that begins to perpetuate itself. And then the asset allocators will come in and start to move money offshore as well. So for me, the bigger risk is if you're not diversified more away from a concentration in the US, that is one thing. Secondly, if you want to diversify your portfolio, I think you should definitely have gold in there, at least partly, and not just treasuries as part of a 60-40. And I would certainly look to have more of an international mix of equities and bonds rather than one that's heavily concentrated to the US just because that's where it's always been.